Good day, everyone. Mike Carnes, Branch Manager, American Financial Network. I'm here to introduce to you a new program. And doing that, I'm going to bring in Mike Farsi, our Product Specialist Manager, who is going to give us some details about that program. I will be back on at the end of the message, and I can't wait to hear what you think about this program. I think it's going to help you get more loans done for your people, for investors. All right, talk to you very soon.
And gaining a lot of attention in the non-QM space, mainly because it's a really light package program. If you're not familiar with it, it's something where investors can purchase or refinance, rate in term or cash out on their investment properties, no income qualification whatsoever. They're qualifying off of property cash flow. When you look at the property cash flow, typically you get a loan as long as the property is self-sustaining. So if you have $1,000 a month coming in for rent and your proposed PITI on the new loan is $1,000, then that's a self-sustaining property. There's no negative cash flow and you can proceed with the loan. You don't even put income or employment information on the 1003. Super easy to do. Couldn't be much simpler. But lately, I've been fielding quite a few questions at the specialty products team desk about one particular lender that's done a very good job marketing their non-QM programs out there. If you know who I'm talking about, then you know who I'm talking about. And recently they've come out with a program that will go to an expense ratio or a debt service ratio on this program of 0.8, meaning if they only have $800 a month in rent coming in and the proposed mortgage payment is $1,000 a month, you have $200 of negative cash flow there. Do the quick math, your ratio is 0.8, and they will still allow that negative cash flow. I thought, this is a bit odd, a little bit crazy, but let me give one of our investors a phone call just to make sure that we can accommodate that here at AFN. So I'm talking to our rep, and he says, oh yeah, 0.8, we've done those. I said, okay, is that a guideline exception? No, it's not a guideline exception. What do you mean it's not a guideline exception? He says pull our qualification matrix, which I've done here. I have it here on my computer. There is a section on their qualification matrix for debt service ratios less than 1.00, which really surprised me. And I said, okay, it says less than 1.00, but it doesn't give a threshold. What is your minimum debt service ratio that you'll go down to? And his answer, which shocked me more than almost anything I had heard all week, which is saying a lot, was quite simply, we don't have a minimum. So what do you mean that you don't have a minimum? So say we have a borrower who's receiving $2,000 a month in rent on a particular property, and their proposed mortgage payment on this new transaction that we're about to do on a cash out refi is $4,000. He says, well, $2,000 proposed is $4,000, so your debt service ratio is going to be 0.5. So I said, thanks, genius. I appreciate that, but I understand how the math works. Is that a loan? Like, is that something that you do? He said, oh yeah, we've done that all the time. Now, mind you, you probably won't be able to get any additional guideline exceptions. So wait, so this is a guideline exception? He said, no, this is not a guideline exception. It fits our guidelines. We do it all the time. We don't have a minimum debt service ratio. So I thought, this is something that people need to know about. But with less than a 1.00 debt service ratio and no minimum debt service ratio, go down to whatever, as long as the property is going to be producing rents of some sort, we'll go up to 75% LTV purchase, we'll go up to 70% cash out refinance, and the program minimum is a 620 FICO score. Now, you can go up to an 80% purchase, you can go up to higher LTVs program-wide as long as you have higher debt service ratios and the property is in a positive cash flow position. But for a property in a negative cash flow position, this is an incredible program for experienced investors to not only expand their portfolio and acquire new properties, but maybe refinance a decent amount of their book of properties into lower interest rates, because I know a lot of investors are acquiring properties on hard money loans, and things with extremely high interest rates. Obviously, we're not looking at conventional rates here, but we're kicking the heck out of hard money.
Wow, Mike, thanks for sharing this information. This is an amazing program. And let me make a suggestion. I think it's time to get on the phone, make some phone calls to your investors, and share with them what you heard. If you like, I'll even get on the phone with you, do a three-way call, and answer any question that they may have with regards to the benefits of this program. I just want to take time to thank you for watching this video. I know it was a little long. This is my first one, so give me a little bit of a break. But I encourage you to still share this information with friends and your clients, and hopefully we can do some business together. My goal is to help you live the good life, whatever that might be. I hope you have an amazing day, and I look forward to talking to you very soon.